Hey everyone, and welcome. Today, we are cracking open a true investing classic, Joel Greenblatt's The Little Book That Beats the Market. We're going to break down his famous magic formula, which is this surprisingly simple system for picking great stocks. So, if you've ever felt like investing is just a total guessing game, stick around. This could be exactly what you're looking for. Let's get into it.
And I mean, how true is that? Let's be real. That's exactly what it feels like for most of us. The stock market seems like this giant, dangerous place where it's just so easy to lose your shirt. What Greenblatt's saying here is that if you don't have a plan, you're not really investing. You're basically just gambling.
So why is it so tough? Well, a huge part of the problem is that, honestly, the market just acts completely nuts a lot of the time.
Just take a look at these numbers. In a single year, Amazon's stock price swung by around 50%. Gap stock swung by over 70%. Now really think about that. Did Amazon's actual business, its warehouses, its website, everything, really get 50% more valuable and then less valuable all within a few months? No way. Of course not.
And that gets us to the most important point of all. The market runs on emotion. It's all fear and greed, and that causes these wild overreactions. It pushes a stock's price way off from the company's actual underlying value. And understanding that difference between price and value, well, that's the whole game.
So that brings up the million-dollar question, right? If the stock's price tag is all over the place, how on earth do you figure out what a company is actually worth?
Let's make this really simple. Forget Wall Street for a second. Imagine your friend owns a little local shop, and last year, it made $100,000 in profit. Now they want to sell it to you. What would you pay for it? $500,000? $1 million? It's a tough call, isn't it?
And that's because figuring out what a business is worth is just incredibly hard. You have to guess what it's going to earn in the future, then you have to decide how sure you are about that guess, and then you have to project all that stuff out for like 5 or 10 years. I mean, even the pros struggle with this stuff. But what if there was a shortcut? What if you could boil all that complexity down to just 2 key ingredients to find amazing businesses without needing a crystal ball? Well, that's exactly what Greenblatt figured out.
Okay, so ingredient number 1 is the price-to-earnings ratio, or PE. Let's go back to our little shop. If you pay $1 million for it and it earns $100,000, its PE is 10. That means you paid $10 for every $1 of profit. If another shop costs the same but only earns $50,000, its PE would be 20. The lower one is obviously the better bargain.
Ingredient number 2 is return on assets, or ROA. Now this one is all about finding a good company. It just tells you how good the business is at making money with the stuff it already owns. So if both shops cost $500,000 to build, but one spits out $100,000 in profit and the other only spits out $50,000, which one's the better business? It's the one with the higher return, every time.
So we want good companies, and we want to buy them when they're on sale. So what happens when you put those 2 really powerful ideas together? Well, that's when you get the magic formula.
And really, this is it. The magic formula isn't some super secret complex algorithm. It's just a filter. It systematically looks through thousands of companies to find the ones that are both good businesses and are selling for a cheap price. It's a disciplined way to take all the emotion out of it. And the results? Well, they kind of speak for themselves. In his 17-year study that Greenblatt ran, the overall market returned a pretty decent 12.3% a year. But the magic formula? It returned an absolutely astounding 30.8% per year.
So to put that in perspective, if you invested $10,000 in the general market, it would have grown to about $70,000. But that same 10 grand using the magic formula, it would have grown to nearly $1 million. Just think about that for a second. The difference between $70,000 and almost $1 million. That's the incredible power we're talking about here.
Okay, so this all sounds amazing in theory, but how do you actually do it? Well, the cool part is, Greenblatt didn't just write a book about it. He actually built a tool and gave everyone a clear step-by-step plan to follow. But first, we gotta do this super important disclaimer. This is for educational purposes only. You should always look at your own financial situation, maybe talk to a professional, and always remember that what happened in the past is absolutely no guarantee of what will happen in the future. So please, be smart and be responsible. Okay, so here's the game plan. You go to the website that Greenblatt set up. You tell it you only want to see companies above a certain size, so you filter out the tiny, risky ones. Then, the site gives you a ranked list. From there, you just methodically buy a handful of the top companies every couple of months until you have a nice, diverse portfolio. After you've held each stock for 1 year, you sell it and just repeat the whole process. This is not a get-rich-quick scheme. The whole point is discipline and consistency year after year.
And that really brings us back to the core idea. By focusing only on a company's quality and its price, the magic formula takes the emotion right out of the equation. It turns that chaotic dynamite factory into a systematic process, and it leaves you with a really powerful question. Could the key to smarter investing really be this simple? Thanks for watching. Subscribe for more videos like this.